Let's round things out with TripAdvisor, a stock popping on results. Seema Mody has the details there. Seema.
Hey, Brian, TripAdvisor's cost-cutting measures are starting to pay off. Earnings came in better than expected, led by experiences in dining, which saw double-digit sales growth, up about 16% in the fourth quarter. Now the question is, can TripAdvisor grow its total revenue, which in the last 3 months of the year fell 3% year over year, led by hotels and its media division. One of the reasons the stock has underperformed its peers. It's down about 40% in the past 12 months. Key question on tomorrow's earnings call: how does it increase its market share in tours and restaurants at a time when consumers are increasingly going to social media to get recommendations, the coronavirus hitting tourism, and what steps is it taking to fend off competition from Google? Guys, CEO Stephen Koffer has been one of the biggest critics of Google and its search practices. So we'll also see what Koffer has to say about that company. Plus, staffing. 3 weeks ago, I reported that TripAdvisor cut 5% of its workforce. Right now, you're seeing the stock pop by as much as 8% here in extended trade. The stock did trade at an 8-year low just about 2 weeks ago, just to put this move into perspective. Brian, back to you.
All right, Seema, thank you very much. I mean, obviously, a little bit of this move after hours probably is going to be short covering, guys. I mean, this is a stock that's wiped out half its value in the last year. The CEO has been critical of Google, basically saying that Google is sort of this thing that's eating the entire industry. But you've got a company that I don't know, Adami, if people care where they go for their advice. You Google, you put something into a search engine, it spits up. TripAdvisor's fighting a pretty big competitor in Alphabet.
Somewhat commoditized. I mean, to your point, this was a not that it matters, but it was a $90 stock 4 years ago as well. The only thing I think you have going for it is two things. You mentioned the short interest. I think it's close to 13%. Maybe people cover on the back of that. And the fact that 29.5-ish was a low we put in back in the summer of 2017. So maybe you have something to trade against. But short of that, there's no real compelling reason to be here. I mean, I think the risk reward sets up decently on the long side, but this is not a name that you necessarily have to be in for any compelling reason.
Well, I think the bar was low here, right? I mean, expectations were low. So, I mean, the macro issue is a very significant one. I wonder sort of in the short term, the micro, this is a decent report, right? So revenue is a beat. That's good. It wasn't giant, but the outlook was decent. So I don't know, maybe with expectations so low, the valuation isn't high. Clearly there's major headwind, but I don't know, might be worth just for a trade.
If you like this space, I mean, I would just look at Expedia. Obviously, it hasn't had a great year, but this is, expected to have mid to high single digits EPS growth and sales growth and trading at 18 times. And obviously, I just think it's a much more defensible model, let's say, than the TripAdvisor. So I just don't kind of see anything in TripAdvisor.
It's a tough place to invest. We all know the headwinds. And to me, Bookings is the only one to own. I mean, they actually have a much more constructive free cash flow. They're kind of at a 7 or 8% free cash flow yield. It's a stock that's certainly performed better. It's a more defendable valuation. It's about 18 times. I think Bookings is the one.